Professor Sundaravali ma'am, the India Gold Policy Center, and IIM Ahmedabad, as well as my eminent co-panelist speakers here. I welcome you all on behalf of MCX, and I just thought that, maybe I'll just share a few slides. An exchange, of course, goes hand in hand with the physical industries that are represented through our contracts or our platform. And gold, along with silver, are indeed the very cornerstone of commodities which are traded worldwide. Not just commodities, in fact, assets which are traded worldwide. Some would argue that gold, on which I'll focus today, in fact is a quasi-currency, and some would argue it's a safe haven investment. It's a hedge against political, geopolitical, economic turmoil. So we shall attempt to delve into the characteristics of gold and what are the instruments with which one can effectively invest in gold, trade in gold, manage the risk of the bullion and jewelry industry especially. So in doing so, this is just a rough structure of what we'll discuss, and open to any questions anywhere during or after. So bullion as an asset class, one of the roles of the exchange as a platform for price discovery, and how an exchange and its price becomes a benchmark for the industry. Risk management platform for the bullion and jewelry industry, helping develop this asset class through products and services, and of course creating a spot to futures integration over a period of time. And of course we'll have a look at few numbers as we go along, just for scale and understanding. So arguably, gold, of course, is an established asset class globally. It has a currency character to it, a store of value, a portfolio diversifier. It is inversely correlated with certain other asset classes like equity and fixed income. It is safe haven. It is a hedge against inflation, they say. They say that, there was a study conducted that over 500 years, so much of, money could so much of gold, a unit of gold, could buy what all, in terms of groceries, in terms of other expenses, etc. And it was found out that that did not change much over 500 years. So all the inflation that took place was absorbed by this asset beautifully. Whether you peg it to currency or not, it will remain pegged to whatever you ultimately call currency. We'll go through a slide which talks about that or proves that. And then, of course, central bank holdings are what we are noticing now. In fact, over the past few months, how central banks, including our own central bank, has been purchasing gold at much higher levels than before. So this is a chart which some of us were discussing around lunchtime about this, that the purchasing power of major currencies compared with gold. So this is a chart which has pegged the base. The index is of January 2000, and this is basically relative value between gold and other currencies. So the value of these currencies in gold terms, you see US dollar, euro, yen, and various other currencies which are mentioned here. It reveals very clearly that the currencies have actually devalued over this time period as against gold. So it is not just against the dollar. We always talk about dollar, but in most currencies, it establishes over the past 24 years, this is the trend. This is just a chart which shows how equity and gold are more or less inversely correlated if you see over a period of time. And this is why it belongs to your portfolio as a shield or a hedge. It works when other assets don't. So that is why it should remain apportionment of your portfolio should be in gold. Now this is very interesting. This is, specific. So specific years of high inflation. So there are three buckets there: less than 2%, moderate is 2 to 5%, and higher than 5%. So high inflation. So you can see that on the left hand side, the axis tells you how much nominal return gold has generated when those years have been bucketed together, which had various levels of inflation. So you'll realize that gold has given about 5% return or 4% return in years which have seen very low inflation. That goes up to around 8 or 9%, between 2 to 5% of inflation. And years in which inflation has been higher than 5%, you see gold has given a much higher return, nominal return of 25% and a real return of close to 14%. So hedge against inflation, QED, right? Now coming to when we talk about financial distress, so these are those specific years which are known for crises of various types. And we have actually sketched out the performance of gold during those years in percentage terms. We have sketched along with that in another column the dollar index and its performance in the same years, and then the S&P 500. So you can read, if you see the leftmost column, 1978 or 79, this is the time of the oil energy crisis. Gold gave a 35% return and 133% return that year. Japanese asset price bubble and Black Monday, 1987. You can see around 20 and 25% respectively. And then so on, the story goes. So dot-com bubble you're all aware of, 2001-2, again 25%. The global financial crisis of 2007 or thereabout, you can see the return, 31%, and so on. And the most recent one being the COVID-19 crisis. And that, I remember because it shot up in the volumes, reflecting on our platform is one, but I think March to September, gold actually doubled, and so did silver, March 2000 to September, the same year. So at the times of economic distress, gold is considered to be a safe haven instrument. So these statements, what we often hear, we should actually go delve deeper into them and really try to see whether they're accurate. So definitely there is something there. Just to map out the global, commodity futures as well as options trade, how it is, shaping up, or globally how we stand. So this is the FIA study, the Futures Industries Association, and this is the volume traded on various exchanges in lots. So you can see there, in terms of gold, we have COMEX, etc., and then MCX is at number 5. In silver, MCX is at number 2. This is the futures by way of number of lots traded. So it is actually an Indian institution, I should be saying. That is the more accurate or better way to say it, but here we are MCX. And global ranking by way of options, as you know, options is fairly recent phenomenon in India. We launched the first option in gold in 2017. We followed it up with some portfolio expansions of variants, and silver was even later than that. And it is at number 4 in gold and number 2 in silver in terms of the number of lots traded in options. Now, coming to the need for a domestic price benchmark, because in India, so there is a value chain, and then there is a consumer who is already had a fancy for gold for generations, and there was a need to have a benchmark. So it should be like this, that if I walk into a jewelry shop, I should ask that what is the price of a particular platform? Are you providing me something that kind of a credibility? Or are you charging me 10 different prices in 10 different cities? So there has to be a benchmark. So in a way, although here futures has come, the options has come, and spot is a subject we're still dealing with, but then people, when I say spot, I mean an organized spot product which is traded. Which has of course been launched, EGR. It has its own issues which are being worked on regarding GST. But then people have started deriving the spot prices from the futures, and that is how the trend started, and like a one nation, one price. And it's important to allow people to hedge whatever is a variable in their price. It's not only about the international gold prices alone. It is about custom duty tariff, which changes fortnightly, as well as the exchange rate. That is how you get a composition of an India price. When you say 76,500, it has these three elements, and therefore it is a product which can be used for hedging. Only therefore, I should say. Otherwise, you cannot hedge in parts. So then, most refiners, traders, value chain participants started maintaining MCX-based prices in various ways, and it soon became a sort of a common practice to fix with the bank and then hedge your position on the exchange, and so on. And the usage of the products has only been not only penetrating into more value chain participants, but also they are learning to use it in various more effective ways, in combinations of futures and options, etc. So today, yes, when a customer walks into a jewelry shop, they often ask for the exchange price. Exchange ka bhav kya hai? But wo to exchange ka bhav to ye tha. So that, of course, it's an ongoing journey. It has to lead ultimately in a country which is as populous and as diverse as us. And it also is the second largest consumer of gold in the world. So definitely it is our business globally also, which IIBX is also trying to attempt, and that's very good. So the faith also gets revealed when people enter into various types of arbitrage situations between 1 month and another month, cash and carry arbitrage, they maintain stock, and so on. It becomes a very diverse kind of a service which is provided to the industry. So like I said, the industry and the correlation with international prices as well as the domestic spot prices is very important, and it is near 100%. And India is so placed geographically that we get to see what's happening across the world in a given trading day, because we start with Japan and then China by around noon, and you have Europe then towards the afternoon, and in the evening US opens, and which one? Yeah, Singapore as well, yes. And then US opens in the evening, which has liquid electronic markets, and then after all that is done, then India, MCX shuts, now at 11:55 at the night. This is what a typical value chain looks like. Miners, international banks, importing banks, domestic, bullion wholesalers, refiners, jewelry manufacturers, and retailers, and then ultimately the consumer. So all of these steps in the value chain represent companies, and those companies have a certain risk which is associated with the price volatility, and that requires to be managed. If you don't manage that, then basically you're into a speculative business. Not doing anything about risk management is basically speculation, because volatility, they say, is the only certainty that you have to deal with. This is that volatility which I was talking about. This is a chart of daily volatility sketched across just a time period of around 4-5 years, 5 years maybe, and you can see that on an annualized basis, gold is still there about 11% odd, and silver is of course known as a more volatile cousin, or whatever you may call it. It takes its cues from copper as well as gold. It's an industrial metal as well as a precious metal. So there the volatility is close to 19%. So we definitely require a hedge there via futures or options or both. And if you see here, we have been witness to over the past, let's say, COVID era and thereabout, or it's not linked to COVID, I'm not saying that, but then the organized jewelers have continued to grow. This sector is seeing some sort of consolidation wherein the organized players are getting bigger and there is a salience for buying organized jewelry, I mean branded jewelry. So that sector has grown at 8%, whereas, I mean the overall jewelry sector has grown at 8%, whereas the organized market has grown from 22 to 37% during this 2019 to 24 period. And the segment revenue of within this, the leading, the leading organized players has grown at a CAGR of around 18 to 19%, which is very healthy. So therefore, they require to hedge their positions, because when you're listed and when you're growing, or if you're doing either of the two, if you're listed, then anyway you have to disclose as part of the listing obligations and disclosure requirements, LODR, that what do you do about your risk, how are you managing it, where are you managing it, what is your risk quantum, etc. So this kind of an awareness is very important for valuation purposes also, not only, so you see that, this mid-segment jewelers who are now getting listed, so many of them, they're using that money to grow, open branches. So this is the kind of change which is being seen recently. We've been witness to maybe the past 2 decades or even the past 1 decade, it was not so much there, the way it is now happening. Arguably or not, I mean, people used to peg the number of total jewelers in India at 4.5 lakhs, and then I don't know how many of them were money lenders and how many of them were really jewelers. But then now also when we talk about, 3 lakh odd number is still there. When we talk of IBJA, etc. World Gold Council had also done a study on this. So therefore, the requirements are only going to grow up, and you can hedge simply with futures wherein there is no profit, no loss kind of a hedge. You can use that to offer fixed price quotations as well as, when you fix your raw material on that side, if you have. So basically, it's a timing mismatch. Otherwise, there's no requirement for hedging, right? So either you have the order, you don't have the metal, or you have the metal and you don't have the order. It's very simple, in simple terms. Whereas in options, you can actually, it's like an insurance premium. You pay for buying a life insurance. You hedge yourself and yet you remain open on the profit side. That is the beauty of options. You can remain hedged on your unfavorable side and remain open on the favorable side. That's what is the beauty of options. They offer an insurance against adverse movement, but allow for participation on favorable side. Maximum loss is known when you enter the trade. It is going to be limited to your premium which you have paid as a buyer of the options. That's why they say it's like an insurance policy. Counterparty risk is not there because it's exchange traded. You get the leverage of futures and the safety you get with options. And but like I said, diverse ways and strategies are there. And then the cash flow management, the jeweler doesn't have to invest money in buying his own raw material fully, fixing it. He can simply lock in the prices and continue his business the way he wants to. He can purchase the gold as and when he needs, in parts, in full, whatever he wants to do, because he's locked in the price on the exchange. And when he gets the order, he has to sell, he unwinds those positions, and that's it. Cash flow is managed better, in short. It creates better cash flow management. Working capital remains where it is required. And duty also gets hedged, as you would have seen when this duty was reduced in one shot by 9%. So if those parties are hedged on MCX or on any exchange, I mean to say, then there is no cause for worry. Otherwise, it is nothing but worry. If you have a drop of 9% in a commodity like gold, right? So, lower transaction cost and lesser capital intensivity in terms of options. You have a right to buy, not an obligation. That is the difference between, so that is what a put buyer. And I can share with you that jewelers who are listed, who are active on our platform, are using, they have been using put options a little bit earlier, but now in a very big way. For what? For the purpose of offering flexible pricing to their walk-in customers during Diwali, etc., during Akshaya Tritiya, to their own admittance. You know, I have, so, and these are leading jewelers which I'm talking about. So this is a very healthy sign that the ultimate benefit of options is passing on to the end consumer. You see, that is where the delivery of promise is. He walks in, he says, today is day X, Diwali is fortnight away. You book your jewelry, either you get this price or whatever is the lowest price between now and Diwali. And that is done by options. That's why we're seeing massive growth in options, massive participation of jewelers in options, and build-up is seen in the open interest. Ahead of every macro event, especially after the arrival of Mr. Trump, you see people are using options more and more, and they remain hedged. The next role of an exchange, one is what we discussed, creating a price benchmark. Then we discussed risk management. The third is to develop this as an asset class, as an organized asset class. You know, purity. Just like you have hallmarked jewelry, you have a comfort of hallmarking, right? So quality assurance. Products which are available in all denominations. You can hold them electronically. You can accumulate them like an SIP. You can take physical delivery if you want. All of these things is what exactly is mentioned here. High liquidity and order book depth creates better price discovery. It gives people chance to do average, you know, pricing and so on. This is just the array of those products. We have 1 kg, which is the benchmark, then the 100 grams, guinea is the 8 gram coin, 1 gram, we are the only exchange in the world. It's a matter of pride for India, for us all, that we are providing a 1 gram deliverable contract, gold petal, and it has seen some very good numbers of deliveries happening there. So in the 1 kg silver bar, so on the silver we have 30 kg, 5 kg and 1 kg. These are the futures, and below mentioned are the 4 varieties of options. And another important aspect, which is recently what we have done about 3.5 years back, is that with the arrival of the BIS India Good Delivery Standard, we introduced a mechanism by which Indian refined gold of a certain good quality, refined in a certain manner, audited in a certain high, strict, fashion, which has been created in line with the international best practices, and we created a document called the MCX Good Delivery Norms for BIS Standard Gold and Silver. So, based on this and then certain eligibility criteria, we subjected those refiners to technical as well as financial evaluation by way of audits. And RJC, our friend Kinjal, is also here. That is also an important, not eligibility, that is a requirement. You have to have that. I mean to say, responsible sourcing. And a committee of external experts which sits along with us, advises us on all these empanelments, and then they are continuously audited at a set frequency. And we have empaneled 6 refiners. 2 are currently on the formal list, 4 are currently active here. And in case of any dispute, we have used the umpire lab as the India government mint. If there is any assay issue between the refiner and the auditor, who is the referee lab, then this is the umpire. And of course, why we did this? This is what we did. The main reason why we did this is because we want to encourage top quality gold refiners of India we want that they should get the same price or the same stature in the same contract in which we have the LBMA. So our prices is our price, and we have LBMA approved refiners in that, we have the Indian approved refiners in that as of date. And we are thinking of maybe expanding this further. And now the next important point is that it helps in reducing price disparities, because you have a tool now. You could melt those, the scrap which is available if it's at a discount, and you can introduce it to the exchange after it becomes an exchange good delivery bar. It reduces the import dependence of India to an extent. Okay, and it basically exchanges the gold from one hand to the other, not only necessarily import. You know, you can, domestic gold can be exchanged. And all of these things, so till now we have seen 10 tons of Indian refined gold delivered, which is a start in the past 2 years or so, valued at over 5,000 crores, and the open interest, it has shown a healthy rise. So this is just the way the turnover has grown. Over the past 3 years, you can see there's a major uptick as we grow along with the industry. This is total gold and silver delivered on the exchange, about 146 tons and 5,300 tons of silver and 146 gold. And the retail products like the silver 1 kg, etc., have seen 4 lakh bars change hands. Since Vasubhai is smiling, we have launched it, I think, only a few years back, maybe 2020 we brought this change, 4 years, 4 lakh bars. And 60, how much is that? 6 lakh 27,000 coins of the 1 gram variety which I am talking about. That also, it was made deliverable in 2019-20. And that's it. Just a few slides to share with you all. Thank you very much for your kind patience. And
thank you, Shivanshu.
Happy to take any questions after.
Yeah. Thanks, Shivanshu. That's quite detailed. Just one question from my end is, what does it take for us to move from the third or fourth position in terms of the total volumes, from that to second, or something that's as good as SHFE volumes, regulatory wise, market access wise? What does it take?
Yes, very interesting. So I mean, first, it has been a journey from 2003. So that is about 21 years till now in existence. So I think some of the participants, first thing is some of the category of participants which is available globally is maybe yet to be allowed or permitted here, which we are eagerly. One is banks who can bring liquidity. You don't really have miners here. Miners and mutual funds and ETFs have been allowed now, they are at a initial stage. So these are the things which actually multiply retail participation as an investment asset, I mean to say. So ETF and mutual funds based on commodity derivatives have started, and they've started picking up well. So this element is one which needs to grow. The second, like I said, banks of their own, the way they trade globally. The third is the foreign participants, so that it becomes secular global participation. That is also, it has been allowed in cash settled contracts like crude and natural gas. We are very hopeful that soon it may be allowed in gold and silver. We are subject to regulatory approval. So when that happens, then you have the pockets around India for whom Indian price is important, etc., like Dubai, etc. I mean, you'll find people from their activity participating here. And the long dated OI which gets created, when you say that there's a long dated depth, that typically is the miners and the let's say pension funds, hedge funds, right? Mutual funds. So those, it's like a chicken and egg situation. So I think very soon when these things, because product wise the array is there. So when these participation elements come, we may see hopefully that further, because we are a very population wise, where we are, and the percentage of people holding demat accounts, if that is anything to go by. So all these are very encouraging signs, and this commodity, as you see, that the organized sector continues to grow. So all of these things put together, we feel it should, once these things are in place, you'll see that kind of a thing internationally.
Thank you. Any further questions?
On the banks participating in MCX, is there any development at all recently? Because RBI now seems to be okay. And the second question from me is there going to be a commodity PMS at all, and can MCX actually do it? Because instead of asking individuals, commodity we can make money. So is there a commodity PMS and these two?
Yes, sure. So I think on the bank side, one thing is encouraging is that the banking subsidiaries who are into broking, for example, just for the name like so-and-so securities, so-and-so direct. So those people are active for now around 4-5 years, and a lot of clientele they carry. That is one. As regards themselves, it is still a while to go. But then going by the IIBX model where they have been allowed to become trading members. So if there is any change in stance like that, then hopefully on the domestic side, because, and then along with that, they could be, people are saying that they should be allowed to purchase domestic gold as well. Then it becomes a complete story. That is one. On the PMS side, yes, PMS is actually permitted, yes, and some people are running it. But then that again, there are some structural, industrial requirements which, if those improvements take place, like how much percentage can you hold in one asset, how much cash you need to be keeping for margin. It's not just, it should not be capped at a low number, because otherwise they'll not be able to take derivative position. So certain changes are requested, I think, once they come about. So the ETF and mutual funds have started growing based on the commodity derivatives.
I think that brings me to a good conclusion for today's track on gold, I suppose. Professor, you have anything to add?
So?
Semi-wholesale.
I wouldn't pass
Category semi-wholesaler.
Semi-wholesale.
Wholesaler.
Oh, you mean to say in the jewelry store? Yeah.
The chain.
Yeah. So people who,
Wholesaler, semi-wholesaler.
yeah. So people who are making different components, it was meant to convey, who make different components of jewelry, then they sort of supply those components in bulk. Like you have certain chains, certain the hooks or whatever.
Bindings, okay.
Bindings.
I would now like to request Sudhish sir to please come to the stage to felicitate our speaker, Mr. Shivanshu Mehta. Thank you. Thank you very much, sir.